Now, this 30.63, it was a 2012 figure. So remember, we updated this. The question says that in 2012, we had 36.3. So the growth took place 1, 2, 3, 4. And that is why we said here, we are saying to the power 4. So this grew 4 times to reach there. So what do? We say, we come here, and there, we also, okay. So now we have 36.3 over 30.9 equals, so this is the fourth root here, and you take the fourth root there. So this is where one of our candidates asked us, so how do you take a fourth root of the number? The other way of taking a fourth root of the number is simply saying 36.3 over 30.9, the whole of this to the power 1 over 4. So that's how we take the fourth root. So what we did here was that we are taking the fourth root. Okay. We are taking the fourth root. So how do you take the fourth root of the number? Is this number itself the power 1 over 4? So that's why we say this is the power 1 over 4. Then you subtract a 1. Then that gives you your growth rate. Linda, that's what we did.
Okay, thank you very much.
Yeah. Now we want to talk about this. This is important. Everybody, this is important because the growth rate in the dividends may not be given. So how do you get the growth rate? You see the most recent value divided by the previous value to the power 1 over the number of times the growth has taken place. To the power 1 over the number of years that the growth has taken place. That is a lesson for everybody. That is a lesson for everybody on how to take the growth rate. Okay. Good. If that is okay now, we can proceed. Those of you who have just come, you found us looking at the question, and the question is here. We've just identified all the variables. We've identified all the variables. So the growth is 36.3. Okay. Brackets 1.0411. So that's the dividend after 1 year. That's your dividend after 1 year. Okay. So the cost of equity then equals the dividend after 1 year at 6.3 brackets 1.04 plus 0.04 divided by 470. So let's go. Can somebody give me the answer here? So what answer do you come up with? What's the cost of equity? What's the cost of equity?
I got 12.1.
Mhm. I'm getting that one. Is that what you're getting?
12.15.
Yes. 12%.
Yes, that's what you're getting.
Exactly.
The only trick here, there's only one trick. The trick was finding that growth. That is the only issue in the question. Okay. Let's continue. Preference shares. Yesterday we came across preference shares. Dividend per share
Yes.
divided by market price per share. So dividend per share, 4%. Times a single dollar. Okay, so that is your 4 cents. Okay. What of the market price? Market price is given here. The preference shares redeemable at are not redeemable and have an ex-interest market value of 40 cents. So the value is 40 cents.
Yes.
So your cost of preference shares equals 4 divided by 40. 10%.
10% exactly.
Yeah, that's 10%. Yeah. So this is how you find the cost of preference shares. Yeah? That's how you find the cost of preference shares. Dividend per share divided by market price per share. So dividend per share is here, market price per share is there. Let's move to the next one. 7% bonds redeemable after 6 years. Okay, now let's go here. 0. Then we go to 1 to 6. Then we go here 6.
Yes, 104.5, the market value of the loan.
Market value of the loan is how much?
104.5. 4.9. 4.9.
So we take that interest is 7%, which is $7. Remove 30% from there. And what are the terms for redemption? What are the terms for redemption?
It's a premium on 5%, which is 105.
So we need to be careful. Eh? It's not at par all the time. Okay. So the cash flows arranged from the investor's point of view. In year 0, the investor would buy a bond. So that is why that one we are putting it as a cash outflow, because we are profiling these cash flows from the angle of the investor. So the investor today will experience that outflow. Year 1 to 6, that inflow. End of year 6, receive that. So let us now find the annuity factor. We say that we start with which rate yesterday?
The one that is given.
Yes. So 7%, 7%. Anyone to help us with the values? Anyone to help us with the values?
What?
Want the annuity factors? Want the annuity factors at 7%?
It's 4.7. It's 4.7. It's 4.767. 767.
Okay. And this one is alone, 0 point?
Zero point
0.6666.
Okay. So at 7%, we're 11. So let's drop that. We are looking for a positive figure. Okay. So let's drop it. We drop it to what level? Can drop it to 4%.
4%.
Okay. Let's have the answers. Somebody can help us. Let's go 1 to 6 at 4%.
5.242.
5.242. That one which is alone. Oh. And that one which is alone.
0.790.
You can't use that that calculation. So you calculate N times O. Column N times O. You should take column L times O.
Okay, let me check that. Let me check that. Okay, so let's go. We take that and multiply by that. Okay. Is that okay now?
Agree?
We're okay now? So what's our cost of date? We go, we say that minus that. And I say that divided by that. Then I say that multiply by that. And lastly, I say 4 plus that. Is that what you are getting? 4.81. Can somebody please counter check the values? Somebody counter check the cost of debt, please.
Thanks.
Are we happy with that?
English dinner, eh?
How much are you finding?
Yes, sir.
4.81.
0.81.
0.048. Exactly.
Okay, the cost of the bank loan is here. Let's put in the market values. Let's put in the market values. What are the market values? Let's put in our market values. We start with equity, 4.7. Shares, 50 cents each. So each share, nominal value is 50 cents. So how many shares? 4,000 divided by 0.5. 4,000 you go, you say 4,000 divided by 0.5 times the price, What is the price there? 4.7. Preference shares, 3,000. There are 3,000 of them. Times 1. Loan note. Loan note is here. 3,000. The value is 104.5.
So on the preference shares, I've just read that they have an ex-dividend market value of 40 cents. Don't know if that's...
Okay. Ah, so I was supposed to divide. No, this was divide by 1 times 0.4. Yeah, divide by 1 multiplied by 0.4. Okay. And that one is just 1,000. Yeah, thank you for that. So let's go. We can now, so that's 8,000 by 4.7. $3,000 by 0.4 and 3,000 times 1.045. Okay, so percentages. Let's go. That divided by that. Then we go that divided by that. That divided by that. That divided by that. Let's put in the costs. Let's put in the costs. What are the costs? Cost of equity, 4.15. Cost of preference shares, 10. Loan notes, Bank loan. And then you got your work. Okay, so that was the answer that we have here. 11.34. Are you getting 11.34? Are we all getting 11.34? Can somebody confirm their answer? Could somebody confirm the answer here?
I agree.
Okay. The second part of the question, discuss how the capital price model can be used to calculate the project specific cost of capital for AMH, referring your answer to the key concept of systematic risk, business risk, and financial risk. Yeah. So if the company goes into a project, the business risks and financial risks have changed. We need to calculate or to recalculate this figure here. So if the new project is going to present a different level of business and financial risks, this figure should be recalculated or re-estimated. How do we re-estimate the business risk? How do we calculate the business risk? How do we calculate the business risk? The answer is we need to calculate a new cost of equity. We need to calculate a new cost of equity. Using what model? Capital asset price model. So the cost of equity has to be recomputed, this one. But we need to use the capital asset price model. How do you proceed? The current bit of the company, you leave it, you abandon it. Because it does not reflect the risk of the new industry. That's what you do. So business risk is adjusted for by abandoning the current beta. So which beta do you pick? Beta from the new industry. Beta from the new industry. When you get the beta from the new industry, what do? You adjust it for financial risk by ungearing and regearing. Then you calculate the cost of equity, which you come and put in this computation. So this figure now, this line will change. That line is going to change. We'll put in a new value there. You put in a new value. Put in a new value there. So put in a new value here. Then you have got the new weighted average cost of capital. The items will remain the same. But to calculate the new cost of equity, how? Use the capital asset pricing model, where you abandon the current beta because it doesn't reflect the risk of the new industry. You pick the details of the new industry, pick the beta from the new industry, and gear and regear and use it in the cost of equity. Use the new cost of equity to calculate the project-specific discount rate. Discuss why the cost of equity is greater than the cost of debt. You can see it's very high, 4.15. Why is it high? Because ordinary shareholders carry the highest level of risk. They carry the highest level of risk in the company. They carry the highest level of risk in the company. The others, the bondholders and even the bank loans, these are well secured. These are fully secured. Therefore, their risk is very low. That is why if you check their return, their cost is also very low because these are secured. These are secured investors. Is that okay, people? Is that okay, everybody?
Yes, I'm happy. Thank you.
All right. There are additional questions. Some additional questions. That's the one that we've just done. That's the question that we've just done. We have another question here. This one involves capital asset pricing model. This involves capital asset pricing model. On the notes that you have, you've got this particular question here. Okay. Let's run through this question. Let's run through this question now. Calculate the market value. Let's work. What are the finances that we have? We've got the loan notes, we've got equity. Okay. Nominal value trading at 5.85, and the equity beta is 1.15. The loan note is here again. Okay. Let's start. Cost of equity equals risk-free plus beta minus what is a risk-free? What is a beta? What is a premium? Let's fill in the values. Let's fill in the values. Let's fill in the values. Risk-free 4. The beta 1.15. And the premium equity risk premium is 6%. So they have subtracted already for us. So the cost of equity equals 4 plus 1.15 brackets 6. What is the answer?
$10.9.
10.9.
10.9.
Okay. $10.9. So that was the cost of equity in this situation. Let's move to the next one. The cost of debt. The cost of debt. Loan notes have a nominal value of 100, trading at 103. The interest rate is 6, and they redeem in 6 years' time at a premium. And they redeem at a premium. They built with a spreadsheet. There's no need of reinventing the wheel. What's the current market value? What's the current market value? Hmm. 103.5, and these are redeemed at a premium of how much? 6%. Okay. There we are. I've got the values already. I'll still use the same 7 and 4%. I've adopted the same values. If you use 6%, is absolutely no problem. If you use a 6%, this bond is trading at the coupon rate is 6%, and let's check the tax. The tax is 25%. So what is the net of tax interest? $4.5. 4.5. Okay. So let's go. What is our cost of date? Cost of date, let's go. That's by please, can somebody counter check my values? Cost of date, can somebody counter check? The cost of date, internal rate of return, Internal rate of return. Internal rate of return. Somebody counter check, please, my values. Want to compare notes? Let's compare notes. Let's compare notes. Let's compare notes. Let's compare notes. Okay, let's put in the values, market values. Equity, 50 cents. So we get 200 divided by 0.5, 5.85. 200 divided by 5.85. What of the loan note? Loan note 200 is here at 103.5, so it's 200. Now you notice they want to double computation. Here they want us to do 200. They want us to repeat this computation. Mm. 200 by 'Are we together there? The cost of, are we finding the same values?
Yes.
Okay, now they said they wanted one market values, another one they wanted you us to use book values. Did you notice? They wanted us to use book values also. Book values. Now, if you use book values, they wanted us to use book values. This question. So, book values. That one was 200. The book values here, you pick them here. Look at what I would do. 200 plus 650, that's 850. Book values is 850. Have you seen the effect of using book values? We have understated the weighted average cost of capital. Why? There's a big difference between market value of equity, and book value of equity. So if they ask you what's the effect of using book values, you're likely to underestimate the cost of capital, and your NPVs, that your discount rate will be wrong, and the NPVs will be overstated. The NPVs would be overstated. The NPVs would be overstated. Okay. So that was the question that we have here. Okay. Calculate market value work and book value work, and comment briefly on any difference in the two values. The difference is because of understatement of market value of equity, which leads to a very low value. And the effect is that our discount rate will be understated, NPV is overstated in project appraisal. Discuss the factors to be considered by the company choosing to raise funds via a rights issue. What are the factors to be considered? Rights issue. What factors do you consider? What factors do you consider? Tax. There is no tax benefit. What else? Financial risk. Will be low. Low financial risk. Another one. Possible. Drop in EPS. So you look at these factors. Via a rights issue, you're benefiting your shareholders. So I want to look at these effects. Your shareholders have the money. If you extend the rights issue, the shareholders have the funds. What issue price would I accept? So these are the factors, because if you charge a very high issue price, that's an issue. What discount are you going to give? So there are some of things. The tax issue, there's no tax benefit. Financial risk, that one is not increased, it's maintained. The EPS may drop. It's a way of benefiting your shareholders, but the shareholders have the funds. What's a suitable issue price? What discount are you going to offer? So you need to consider these factors. Okay, people, log in tomorrow, our usual time, so that we can look at the issues of valuations. We'll log in tomorrow, same time, at 19.
Thank you.
As we look at the issue of valuations, valuation of bonds, valuation of companies, valuation of shares.
Thank you, sir.
All right, we'll see you tomorrow.
Thank you, sir.
Thank you very much.